Now let's look at now some risks we see in the economy, namely Europe, China, and the US deficit. This next chart is showing Spanish 10-year bonds and Italian 10-year bonds. And I throw on that 7% level because anytime the bonds trade above that market, basically it means these countries are being priced out of the bond market. They're not able to fund themselves because the cost becomes too much and they're going to need a bailout. And you can see that a couple times over the last year, Spain and Italy both breached that level. However, yields have fallen off significantly. In fact, the reason why was on July 26th, the European Central Bank President, Mario Draghi, came out and said he would do whatever it takes to save the euro. And what he was referring to was a new program called the Outright Monetary Transaction Program, whereby any country that submits to economic reforms and austerity would be eligible for a program whereby the ECB would buy an unlimited amount of those countries' sovereign bonds. Who is going to short an Italian or Spanish bond with that kind of firepower behind you? So this stabilized the markets in Europe and gave everyone confidence that actually the euro was going to be intact. However, this doesn't mean the problems in Europe are solved. Far from it. One of the issues we think is really significant is labor costs. And you can see the difference between labor costs between Germany and the rest of Europe is significant. You can't have the same currency and have that kind of differential. Either labor costs in Germany have to go up or the rest of Europe have to come down. And I can tell you the Germans are not going to increase labor costs. So you need reforms in labor laws that will bring those costs down. Now, one country, we hear all the time about Spain and Greece and Italy, but one country you're hearing more and more about is France, because France has a notoriously inflexible labor law and labor market, and they are not doing a lot of reforms. And I'll give you an anecdotal comment. Titan International, which is a US tire manufacturer, their CEO had the opportunity to buy a tire factory in northern France. He went over to France to have a look at the factory, and he made an observation. He said, wages in France are high, and workers, they work for an hour, or rather they have lunch for an hour, they talk for 3 hours and only work for 3. He confronted the French unions with this face-to-face, and their reaction is, this is the French way. Well, this is not the Titan International way. He obviously declined to buy the factory, and he opened up a factory in China instead. So this is an example, France, and why a lot of people feel that France is actually the time bomb in the middle of Europe. Now, another thing, we know that reforms need to take place, but they're painful, and the toll it's taking on the economies and the people of these countries is dramatic. And I think unemployment rates is the best way to show that, and in fact, the most dramatic is youth unemployment. You can see in Spain, unemployment for those under 25 years of age, 37%. Sorry, that was Italy. In Spain, it's 56%, and in Greece, it's 59%. What about our time bomb, France? It's 26%. In Germany, it's only around 8%. So again, you're seeing that divergence, and you need to close that gap. So, I think that the fear in Europe is the toll and pressure that's putting on governments, and we're seeing that in some recent elections, particularly in Italy and Greece, where some more radical parties are getting more votes. And the risk and the concern would be that one of these parties would gain control and take their country out of the euro, and we're back into a financial crisis. We don't think it's going to happen, but it's definitely a risk. And it's one of the reasons why, in our opinion, Europe is still the #1 threat to the global capital markets. Another threat or opportunity would be China. And this graph is showing the Shanghai Composite Index last year up just under 6%. Not great and very volatile, but what was good news is the rally we saw at the end of the year and running into this year, a rally of 24%. Very strong performance. The bad news is, since February 6th, the market is off 8%. And why is that? Well, we think the issue in China is inflation. And if you look at CPI last year, you can see CPI in July of last year peaked at 6.5%. This is too high. It means that China has to tighten monetary policy and reduce stimulus spending. They did that, and it worked. And you can see that inflation in China plummeted in October to 1.7%. So this is good news, and I think one of the reasons why you saw that big, sharp rally in the markets. Unfortunately, CPI has again started to move higher, up 3.2% in February, and I think this is why you're seeing that sell-off. The concern is that if China tightens monetary policy, that you could have a hard landing in China. That would be bad for the global capital markets and absolutely bad for the Canadian economy. Now, another risk we see, the U.S. deficit. I like this graph because it shows John Boehner. He's Speaker of the House in the U.S. He's dressed as he's a Republican, and he's dressed as a fiscally conservative German, whereas President Obama is dressed as a socially conscious Frenchman, because they both have different views on how to solve the problem in the U.S. with the deficit. The Republicans, they think you have to cut spending, whereas the Democrats believe you have to increase taxes. They're both right. The Democrats are right in the short term. The Republicans are right in the long term. If you look at this graph by the Center of Budget and Policy Priorities, this is a bipartisan group, so it's not Democratic leaning or Republican leaning. They make the observation that the U.S. only needs to cut about $1.4 trillion over, it's a large amount, but they say only, over the next 10 years in order to stabilize debt to GDP at 73%. In fact, because sequestration happened, which was an across-the-board cut in discretionary spending that happened on March 1st, because they weren't able to prevent that, actually now the U.S. would only have to cut $257 billion. Again, that's not a lot of money. The Democrats argue that the reason why you have the deficits we have is because of the recession. And to their point, the Congressional Budget Office would point out that if it were not for the recession, the budget deficit this year would only be $433 billion and $172 billion next year. The U.S. actually has cut a lot of discretionary spending over the last 2 years, about $2.5 trillion over the next 10 years. So a lot has been done to stabilize the deficit. The problem is that's not where the issue is. It's not in the short term, it's in the long term. And that's what the Republicans are talking about. You can see from this graph, you see the inflection point after about the year 2025, how it moves up. And these lines show that it's not about cutting taxes, especially or raising taxes to the rich, because even if you increase taxes to the wealthy to 50%, and roll back all the Bush tax cuts, you're barely denting that line. You can still see how high that is. The issue is entitlement spending. In fact, it's estimated by 2050, if you maintain the present course, all tax revenue would be used to pay entitlement spending. And entitlement spending is Medicare, Social Security, and Medicaid. The real issue of those is Medicare. And what it is demographics. Right now, there's about 40 million people in the U.S. 65 years or older. By 2020, there's going to be 55, and it's only going higher. Republicans, Democrats, they both know this has to be dealt with. You have to reduce Medicare spending in the U.S., or you're going to end up like Greece.